Check. Okay. Hello, everybody. Welcome. Okay. I think I have my settings set up correctly. Can you please, guys, let me know in the chat whether you can hear me loud and clear? Please give me a thumbs up. And also, please type something randomly in the chat to see that I'm actually looking at your messages before we begin. Okay, I see people joining in. Hi, everybody. Welcome. Hope you are all having a lovely Friday. Please bear with me for a few moments and we will be on our way. Okay. Hi, Gabriel, Gloria, Hillary, Johan, Jonathan. I see Paolo. I see Prince Nuaco. Sorry if I'm butchering any guys' names. Okay, people are still joining. Welcome, guys. Let me know whether you can see the first slide of the presentation. It reads Webinar Introduction to Fundamental Analysis. This is our topic for the day. If I'm not mistaken, this is the third episode of our series. And again, this is going to be a super basic intro. That's all it's going to be. Don't worry. We're not going to dive into any super complicated topics. This information that is going to be conveyed through these webinars is going to be super simple. It's merely used for a brief introduction into the world of fundamental analysis, and there is a lot of information to cover on the fundamental analysis front. What we're attempting to do here is, in a sense, set the foreground in order for us to build from here onwards. Okay, so if I'm moving way too fast, let me know. If I'm moving way too slow, again, please let me know. I'm going to adjust accordingly. If you do have any questions whatsoever or something is unclear as we go through this webinar, again, please communicate with me via the chat or the Q&A box, okay? Hopefully you guys have access to that. Please send me a thumbs up or type something to see whether it's actually working properly. If not, I'm going to fix it as we go, actually right now before we begin, okay? So I see people still joining. Welcome, guys. Okay, maybe it's time to begin. And if someone joins from here onwards, probably we're going to do a small recap if it's needed. Okay, for the time being, let's begin. So again, welcome. Introduction to fundamental analysis. This is our topic for the day. And I'm moving on to the second slide. It's a risk warning and a disclaimer at the same time. I'm not going to go over this in a sense. What the information that is contained within this webinar is not by any chance investment advice or investment recommendation. It's for educational purposes only. At the end of the day, the redistribution of the material is strictly prohibited. That's all you need to know in a sense. So what we will go over in this session, this is the agenda in a sense for the day. So we're going to do a brief intro on what fundamental analysis is. We're going to provide a definition in order for us to understand what we're dealing with here. Then we're going to deep dive, not that much, but we're going to examine in a sense or bring forth the four main pillars, if you will, like a fundamental analysis. At least these are the ones that I find personally helpful to study because they capture pretty much all of the economic information that comes into the market on periodic basis. So if you are covering pretty much all of these four categories that I've outlined here, pretty much you're going to be equipped to deal with what the market throws at you in regards to economic news releases that are, again, periodically released in the market, and they are affecting not only the FX market, they can affect the prices of or how, for example, some precious metals behave or some other commodities or equities. They are all interrelated because we're talking about broader economic let's just say parameters or components that do affect the way things work in the wider global economic scheme, mostly from a country-based analysis, but from there onwards, when you have interrelationship between nations, when you have this kind of global hegemony or this global relationship between nations that are exchanging value and goods between each other, there is no surprise that you're going to get some sort of shock waves from one country into other countries as well. This is the world we live in 2025, super interconnected. So if one economy is struggling, most likely due to the relationships that that country has with other nations, is going to have some sort of impact on other nations' economies as well, because we're dealing with the global financial frame, if you will like. Okay, so again, this is a macroeconomic kind of point of view. Still, fundamental analysis, we're going to provide a definition and overview of what we're going to deal with. Then we're going to do inflation, interest rates, growth, and employment. I don't know if we're going to be able to cover all these four main kind of categories from the get-go. Hopefully, we're going to cover as much as we can. Possibly if we do inflation and interest rates on the first go, it's going to be super interesting. If we do growth as well and employment, it's going to be an extra plus. So what is fundamental analysis? Okay, welcome guys. Sorry, I see people joining in. Welcome. We are about just to begin right now. We're going to provide you with a definition of what fundamental analysis is and what we're going to be dealing with, and why do we care about conducting or paying attention to fundamental analysis or doing the practices of fundamental analysis in order to benefit from what kind of benefits this study brings to us, what kind of value brings to us when we actually devote time to it. This is the main goal, in a sense, in this kind of slide. So this is the broadest definition you can get in regards to fundamental analysis. So as such, this is the study of economic but also political forces and how they act and what kind of influence they have and on the global international scene, in a sense, and more specifically on currency exchange rates of countries. Okay, so economic and political forces, the study of this and how they determine or influence the valuation of currency exchange rates of countries. Okay, we're starting from a FX point of view, but if you extrapolate further from this, it has wider shockwaves, if you like, on other asset classes and markets as well. But primarily, we're going to focus on the FX aspect of things, because primarily economic news releases have the most impact on FX rates rather than other categories. They do have effects on other categories as well, but they're not as harsh or as grave as the consequences that they have on FX rates. Okay, so therefore, fundamental analysts or fundamental analysts, those that are performing these kind of tasks, look at various economic indicators, and we're going to talk about them, that give, in a sense, a sneak peek at how an economy is performing. Why do you need to pay attention to how an economy is doing? Because from there onwards, it's kind of predictable, quote unquote, with big quotes, predictable on the word predictable on what's going to happen to that nation's currency. So if you understand the wider macroeconomic factors that do affect the country's economy, from there onwards, you can extrapolate with a high degree of certainty what is going to happen to its currency. And that is the reason why we conduct fundamental analysis in the first place, to find this, to understand how an economy is behaving. From there onwards, to have a higher degree of probability of placing a trade that is going to be either beneficial or, on the contrary, negative, if you would like, to that country's currency, depending on the economic indicators or the economic news releases that that nation is bringing forth. Okay, so analyzing these kind of economic indicators, which may be, for example, GDP, the growth, the gross domestic product of a nation, how good is that nation at producing things, or another economic indicator, which is the trade data or the trade balance, which measures how much a nation is exporting and how much is importing. What is the difference between the two? Okay, with whom is conducting, let's just say, trade dealings with, and that's going to affect as well the FX rate of the nation. We have other economic indicators such as inflation, CPI or PCE, if you would like, which are measuring the how much prices are changing, of average prices of a broad basket of goods is changing over time, and how that is impacting the purchasing capabilities of that country's citizens, which has a lot to do, which is a big kind of category that affects how valuations are taking place from there onwards. You have plenty of economic indicators. Hopefully, we're going to cover them as we progress throughout the series, but for the time being, is this we do analyze as fundamental analysts the impact of economic indicators in order to have, in a sense, an edge in the FX market by having a high degree of probability of placing a correct trade, okay, or a trade that's going to be beneficial to us. That is the reason why we conduct fundamental analysis as such, okay? So analyzing the data allows fundamental analysts to assess the situation and come to a conclusion on how to position themselves in the market. So we are not doing this because, oh, it's a fun thing to do. No, we're doing this in order to extrapolate value from and insights from the analysis that we're going to perform on that specific nation and its economic news releases and indicators that come out periodically in order to come up with a plan and act upon it in order to make money, to trade, in a sense, this kind of news. Okay, so fundamental analysis is primarily used and applied for medium to kind of longer term kind of durations, if you would like, as market events unravel over time. However, it could provide some sort of valuable insights in the short term as well when combined with technical analysis, the topic we have discussed on the prior webinar. Okay, so at the gist of it is that if you do pay attention on economic indicators, of course, you can draw a longer kind of point of view picture of what's going to happen to that specific FX pair, but you can use that information, that same information, to capitalize on short-term market moves. For example, if you tune in next week when we have the United States releasing its non-farm payrolls report for the month of January, if you have observed an NFP event taking place or an NFP release taking place on the first Friday, in this case, it's going to be the second Friday of this month, you're going to see that it's a lot of volatility because of the results. So these results, these economic news releases results do matter, and you see volatile kind of swings if we see some sort of results that are above or below expectations. And we're going to see, and we're going to talk about expectation theory as well in order to grasp it. But the point is that these releases do yield some sort of reaction in the market. And if you do your homework and you have your assessment, and if that assessment aligns with your point of view, the actual result, aligns with your point of view, you can capitalize upon that. You can play these news releases at the time they come up, and you can make bank. Okay, so that is the reason why we do fundamental analysis. I wanted to make that completely clear. Is anyone having any questions so far, or shall I keep going? Chat box is empty. Perfect. That means you guys are okay. So let's start with the first of my personal four-stage categorization of economic indicators. Okay, this is going to be about inflation. Inflation has been a hot topic, still not that much, not that hot in January of 2025. But if you go back a year and a half, 2 years back, we had this kind of hot problem that was inflation, where we had skyrocketing prices of goods and services due to high demand and let's just say moderate supply, that led to a high appreciation of goods and services within many nations or many developed nations' economies. Primarily, this was in the aftermath of the COVID-19 pandemic. As things started to come back online, you see people flocking back into the economies, into the market, and spending money and having high demand keeps prices or pushes prices higher, elevates, in a sense, prices. And hence, since we have high this average of prices rising over time, this creates what we call the problem of inflation, which some may say, yeah, it's not that big of a deal. But at the end of the day, this, if you look at it from a different standpoint of view, from the consumer's point of view, high prices of rising prices of certain basket of goods that you use pretty much each and every day, it's losing, in a sense, or it's slashing from your or stealing, in a sense, quote unquote, stealing from your pocket money that you could have spent somewhere else. Okay, that means that the stuff that you bought 2 years ago with an X amount of money, now you cannot get the same amount of goods for the same amount of money. That means you have to spend more, in a sense. That creates what we call the loss of purchasing power from the consumer's point of view, which is a problem. And this is what central banks need to address. And that's why you have the reaction from central banks. Helpful or not, I'm going to leave that to your discretion. But yeah. So what is inflation? Inflation is essentially the rate at which the general level of prices of goods and services within a nation or globally are rising. Okay, so another way of conceptualizing inflation, this is about the measurement of the loss of the purchasing power of every unit of currency per year. Okay, so from consumers' point of view, from our point of view, this is not good when you have high or raging inflation pressures, because again, it diminishes your purchasing power. You need to buy the same things with more money. So in a sense, you have less money to spend on other things. Okay, so inflation is measured primarily on an annual percentage or a year-on-year kind of metric. Might be 5%, might be 2%. Currently, pretty much every major economies having around a 2 and a 3% kind of inflation, comparing that with the same nation's inflation rate over the past, year and a half, which you had 4 or 5 times that. So 8, 9, 10, 11, 12%. So from there on, from this past year has been a disinflationary kind of trend in regards to price pressures. We are at a better stage, but still pressure is still felt by consumers. Okay, so inflation, as I just said, is measured on an annual basis, not only on an annual basis, but on a monthly, but also a quarterly basis. That means every 3 months you get a specific percentage that, averages out the prices of goods and services for that specific period. Now, which one is the most important? That's up to interpretation. As a general rule of thumb, most likely the year-on-year is the most important one, but also the other ones are important as well, because they give you snapshots of the same thing from different periods, from the same period, from smaller periods. Okay, so let's go over an example to make things clear if you're not really familiar with the term of inflation. So let's just say inflation is 10% on an annual basis. Let's get that for granted, okay? So what that means is that essentially a loaf of bread, a basic commodity, a basic, let's just say, need for, I'm not going to say every household, but the majority of households around the globe. So every loaf of bread that cost $1 in 2021, okay? Now, assume that we are in 2022, it will cost $1.10, okay? So that's what 10% rise of inflation means for this kind of good. So that means that your $1 will now buy you less things in 2022 or 2025, whatever that is, okay, compared to the prior year. So in a sense, you can buy the same thing with more money. We are another way of conceptualizing is that you have less money to spend on other things, okay? Or yeah, that's pretty much it. It's a simple concept, okay? So over the past few years, as you may know, we have the majority of global economies facing rising inflationary pressures, and central banks had to act accordingly in order to address the issue. And we may say this has been pretty much brought under control, and the measure that central banks used to bring down inflationary pressures was raising interest rates, which is going to be the second topic of conversation from here onwards. But before we do that, let's still examine a little bit further on 2 occasions where when inflation gets out of hand can be catastrophic. Okay, so one is what we call hyperinflation, so that means way too high, and the other one is going to be deflation, which is way too low. Okay, so from this mere or simple explanation I just gave to you, you can draw the conclusion that yes, inflation is not that all bad. The extreme cases of inflation, either hyperinflation or deflation, are indeed bad and can bring catastrophic consequences, and that inflation on the grander scheme of things is something that you really do need within your economy in order to keep things moving, okay? And we're talking about a specific super low and stable level, okay? Most central banks have a target of 2%. For some reason, they came to the conclusion back in 1996, and the first one to do this proposal, if you will, like a 2% inflation target, if I'm not mistaken, was the central bank of it was RBNZ, the Reserve Bank of New Zealand, that came up with this idea. Oh, we need to have inflation stable and steady at 2% in order to maximize, in a sense, the economic prosperity of nations, okay, of our nation, New Zealand. And from there onwards, many other central banks adopted this kind of 2% target because for some reason, due to empirical studies, they say 2% is sufficiently good enough for an economy to grow steadily and safely over a prolonged period of time. So no upswings, either extreme levels or super high levels or super low levels are beneficial. So a basic slow rising of inflationary pressures over time is what economies need in order to grow safely. Okay, that is in theory. In practice, we do get a lot of volatile swings, much like we have seen back in 21, 22, where we have seen, as I just mentioned, inflationary pressures rising radically from, let's just say, 1 to 3% up towards to 9, 10, 11, and 12%. Maximum I've seen is Bank of England around 12%, if I'm not mistaken. But from there onwards, central banks came back into the market, raised interest rates, and brought inflation back down. Okay, let's go back to the topic. Hyperinflation, we're talking about extreme levels of inflation. Okay, so we're talking about the rise of prices getting up that much quickly and rapidly that money, in a sense, practically becomes worthless. Okay, and that was an actual case that took place in Zimbabwe back in 2008. So one of the worst instances of hyperinflation was recorded in Zimbabwe back in 2008, where we saw inflation to be somewhere around, and this cannot be measured accurately, 231 million%. Okay, so we're not talking about 10% rise of inflation. So the bread that you bought last year was worth $1, and now it was $1.10 with 10% of rising inflation pressures. We're talking about $1 worth of bread, okay, worth 231 million just 1 year later. So the paper money you have or the digital money you have, in these kind of extreme cases of hyperinflation, it worth absolutely nothing. So this is a situation where you see governments and nations collapse, okay? Because the value of the main way of exchanging value, which is what we use, currency, money, fiat money, okay, becomes so worthless that you cannot do anything. Imagine going to the bakery and placing 230 what was it, 231 million £1 notes on stacked within I don't know, a trolley or whatever to go buy a loaf of bread. Okay, it's inconceivable. You cannot plan finances for the future. You cannot trade efficiently. You cannot pretty much do anything. Okay, so in these kind of extreme cases, you have some sort of guardian, with big quotes, guardian angel kind of International Monetary Fund players come in and try to save the nation by giving them loans and all that kind of stuff in order to fix the economy back again. But normal, everyday, day-to-day consumers and people, because money is worthless, what they do is just exchange items with each other, much like we have been doing as human beings before the invention of money or fiat currency, in a sense. So in a sense, I am a farmer and I have chickens, okay? And today I have a dozen eggs. You're a skilled baker and you do bread. Okay, I'm going to give you a dozen of eggs. You're going to give me 2 loaves of bread, something like this, okay? So we these economies in hyperinflationary environments where the country becomes worthless, and in a sense, transactions and exchange of value cannot be done via the modern way. They go back to our roots as human civilization, and they exchange value, they exchange items in order to survive. Okay, so again, mind you, the surviving aspect of things, if someone wants to thrive in this kind of environment, in this kind of economy, there's absolutely no way. There's no savings, no nothing, no investments, no bringing up businesses, no nothing. Okay, so this is the real danger of hyperinflation. Extreme cases, yes, but we're using them as case studies in order to understand how inflation affects economies. Okay, they are extremist versions. So moving on to the others side of the spectrum, if you will like. So hyperinflation is prices rising with a super rapid pace. Deflation is the opposite, where prices are rapidly falling. Okay, you may say, well, this might be actually good. Yeah, who doesn't want buying cheap stuff? Okay, you will see how that affects this extreme case of deflation, how that affects an economy. Okay, so the opposite of inflation is called deflation. Okay, so deflation is a rapid fall in average prices. Again, your question maybe was wrong with that. So if at the end of the day prices are, excuse me, falling constantly, okay, people, consumers, and pretty much every other player within the economy is having an incentive, okay, to wait before buying things. So what's the point of me going to, I don't know, a BMW or a Honda or a Maserati, whatever car you would like, dealership today to buy a car worth, I don't know, $50,000, euros, whatever that is. Okay, if I can wait 1 year and that price of the same car, the cost price in a year's time is going to be, I don't know, 30,000. Okay, so what's the point of me acting today if I know next year, or I'm expecting next year, prices to fall that rapidly, okay, to fall down to from 50,000 to 30,000? Isn't that a bargain for me? Why buy it now where I can buy it later at a much cheaper price, almost 50% off? Okay, in that kind of case, it was what, 35, 40%. Okay, so what's the reason of me doing that? If the majority of people, or a critical mass of consumers and people within that nation, have this kind of same mentality of holding payments, okay, holding purchases because they expect prices to fall in the next, I don't know, whatever period, this creates a negative feedback loop, okay, and causes prices to fall much faster. And if prices keep falling much faster because we are there is no demand from consumers to buy things and goods and services, is falling rapidly, this creates this kind of catastrophic environments where you start seeing businesses closing down and people losing their jobs, because those that are selling, they're not selling. Okay, because we as consumers are holding back from payments, from purchases. Okay, so this is going to create a catastrophic event where all these kind of businesses are going to go, in a sense, this kind of enterprises are going to go out of business because there's not enough demand, there's not enough money circulating the market to keep the economy growing, or at least sustain the economy from not facing or not falling into a recession. Okay, so you see the two extremes of this kind of situation. One where you have rising prices where money becomes worthless, and the other one that when prices are falling rapidly, people are not incentivized to buy things. And the reason why we see, you might still have a question, why is bad not buying stuff? Okay, the reason why is because pretty much all modern era kind of economies that we have right now are purely based on consumption. Okay, so if an economy is not, if a nation's consumers are not doing their job to buy stuff and recycle money, push money through the life cycle of the economy, that is not good. Okay, that cuts the flow of funds within that economy, and if that economy stops consuming, which is not going to contribute favorably to the growth of that nation. Economic is that economy most likely is going to slow down and possibly face a recession. Okay, because the mechanism that we have in place at creating value and growth is based primarily on consumption. So if you slash consumption, if you have a bottleneck on consumption, if there's a radical fall in demand and there's no purchases from the consumers within that nation, that's going to stifle, or it's going to choke hold, in a sense, the economy, and it's going to push it towards recession. And recessionary environments are never good, except from those that do have money and strategy and can capitalize on the fall of asset prices in a recession and, in a sense, buy what we call the dip. Okay, but those are for the select few. The majority of people is in dire straits when it comes to a recessionary kind of environment, depending on what kind of country you're coming from. For example, the United States in 2008 was a massacre for a lot of people. And we're not talking about high net worth people. We're talking about low income and middle class. In a sense, the middle class was pretty much eradicated back in 2008. In nations across the Atlantic, for example, in Europe, same thing. The effects came in somewhere around 2009 and 10, same scenario. Lower class and middle class faced a lot of problems after a recessionary environment. So the reason why we say recession is certainly bad is because it pushes down, it squashes down the purchasing power, but also the will and the optimism of everyday day-to-day consumers, or what we call common folk. Okay, that keeps this kind of consumption engine running. Okay, so enough of me blubbering. So I have a question, guys. Can I send this via slide via email? Of course, yeah. I'm gonna arrange that after we finish, Rene. Okay. Sorry, guys. There was a question in the chat. So yeah, enough of me blabbering about inflation and deflation and hyperinflation. Let's move on to the next slide. We're gonna be talking about interest rates. Hope you are all guys familiar with the term interest rates. So primarily, we have talked about inflation, which is the rising of prices. The interest rates is the primary tool, okay? The only thing central banks can do in order to bring down this, okay? So inflation is, in a sense, fought by central banks via the usage of interest rates, via manipulating the interest rate of that country's, of that nation's, let's just say, supply of money, okay? Via raising or slashing interest rates, okay? If you're not familiar with interest rates, here we go. So we cannot say the words interest rates without mentioning central banks in the same sentence. So they go together because interest rates are indeed the tool that central banks use in order to contain inflationary pressures. And this is in pretty much all major economies, one of the two tasks that these central banks have. One is control price pressures or control inflation, have it steady around the 2% target for a prolonged period of time in order to allow the economy to grow. And the other task they have two tasks. The other task they have is keep employment trends steady as well. Okay, so having enough people in the labor market force in order to work and produce goods and services and get paid for them. And when they get paid for them via salaries, they're going to spend it in the economy, and the economy is going to grow from there onwards. Okay, so these are the two tasks that central banks have: control price pressures if they get extreme, okay, and maintain an effective and efficient labor market, okay, workforce, employment, in a sense. Okay, so the major job, however, is inflation, and that's why we have seen all of the central banks over the past 2 years, with the notable exception being the Bank of Japan, all major central banks running to raise interest rates in order to combat rising inflationary pressures. Okay, so rise of inflationary pressures, rise of price in goods and services over the past, what was it, 2021, 2022, led or caused or forced central banks to act, okay, to contain and bring down inflationary pressures once again by deploying the tool they have available for them at their disposal, which is raising basically interest rates. In this kind of case, because we have rising inflation, their tool of preference was to their act of preference was to raise interest rates, okay, elevate the interest rate level in order to bring down inflation. If this is woo-woo for you, if this is not, if this is still unclear, I'm gonna go and break it down for you in order to understand how this kind of mechanism works in regards to interest rates I'm talking about here. Okay, so let's go back to the slide. So central banks tend to focus on controlling inflation, primary mandate. As a matter of fact, most central banks have a mandate which is to keep inflation low and steady somewhere around the 2% target per year. And again, the 2% target comes from RBNZ back in 1996 or 98, the example I mentioned before. Okay, so now let's consider two scenarios. Okay, the first scenario is when inflation falls below the 2% target. Okay, so 2% is what we want. Inflation is at, I don't know, 1% or falls to 0 or falls to -1 or -2. For example, look at Chinese economy right now is having problems with what we call disinflation. That means inflation in China is below the 2% target. Okay, I'm not sure where it has stabilized in the past month or so, but last time I checked, it was in negative territory, which is not good because you can actually see this kind of avalanche where you fall onto the deflationary kind of scenario where prices fall rapidly and you cause that mass recession event. Okay, so central bank of the PBOC, the People's Bank of China, is doing this kind of work in order to bring inflation back down. Okay, because the inflation, the price of goods and services is falling at not in a desirable manner, if you would like. Okay, so when inflation falls below the 2% target, central banks usually lower interest rates in order to boost inflation. Can someone tell me why lower inflation, lower interest rates in order to combat falling inflation pressures? Does someone know? No, no worries. So the reason why you lower interest rates as a central bank is the reason, in a sense, interest rates are a direct channel between consumers and banks or institutions that provide financing to these kind of consumers. Okay, so lower interest rates means, for example, you want to buy a house, okay, and it's worth $200,000, whatever that is, euros, yen, whatever it is. Okay, so you need to buy a house, okay, and interest rates are at 0%. Okay, some economies have had interest rates at 0% in order to stimulate growth. And this was back somewhere around 2014, 15, 16, or 17. You had pretty much all major economies had super low interest rates. And the reason why they've done this is because they wanted to give the capability towards consumers and businesses and entrepreneurs to borrow money from banks cheaply in order to use that money to set up businesses or to buy houses or to create, in a sense, some sort of growth within the economy. So low interest rates, for example, if you can get a $200,000 loan and the bank is asking for 0.5% of interest or 1% of interest on your down payments, in a sense, for that specific house, that is pretty much affordable from everyone. Okay, assuming that you have already a down payment, okay, and you qualify for that loan. That loan of 1% is pretty much something that it's a good deal in a sense for you to get. Okay, so when you have rising interest rates, however, you bought your house, you sign your papers for 1%, and you have a variable rate. And for some reason, central banks tend to decide to raise interest rates, for example, from let's just say 0% to 4%. Okay, now your payments, your interest payments, a percentage of your interest payments that you're going to be paying monthly is going to also rise to possibly higher than the 4%, so possibly 5%. So you're in a sense paying 5 times more on the same house, or with the payments you have, it's going to be 5 times higher than when you purchased your loan at the beginning. So in a sense, the bank is requiring more money from you in order to safeguard, in a sense, your loan from your home. Or another way of conceptualizing the reason why you have low interest rates is to give businesses and new entrepreneurs availability and access to capital in order to set up businesses, okay, in order to provide or give to the market back a good or a service that could contribute positively to the economy. Okay, so low interest rates are related to growth and expansion. Okay, because you give, in a sense, free money to people to. You give the option to people to borrow money cheaply in order to do whatever they want. And when you have high interest rates, in a sense, that kind of discourages people from getting loans, because you have the payment aspect of things, the interest payment aspect of things at a high level, which is going to help them, which is not going to help them, which is going to discourage them from getting randomly a loan in order to, I don't know, buy a second car or whatever that is. Okay, so this is a mechanism created or used by central banks in order to control the supply of funds within the economy, and this has direct effects on how consumers behave. Okay, so low interest rates tend to bring optimism within an economy because you have access to free capital, and you have innovation and creativity or whatever that is rising. Also shitty businesses at the same time. But during periods where you have high interest rates, you tend to have much more conservative point of view when it comes to the future. So you need to plan much more rigorously to create a business that is going to last within an environment that has high interest rates. Okay, which is the scenario number 2, which is when inflation is above the 2% target. The scenarios we have seen back in 2021 and 22, central banks tend to raise interest rates in order to bring inflation back down. And in a sense, if inflation is way too high, that means demand for goods and services is high. Okay, that's the reason why we have seen this kind of rise of prices, because more people want more things, and the things that we have available are the same. More people want the same things. Inflation or prices of goods and services tends to go up. And the reason why central banks raise interest rates is to construct, in a sense, to restrict, in a sense, this kind of demand, this excessive demand from consumers from buying stuff within the economy. Because if they keep buying things with the same rate, inflation is going to keep moving higher. This is going to bring the scenario of hyperinflation, which is going to be catastrophic. Okay, so the reason why they raise interest rates is, in a sense, to discourage people from getting loans on stuff that are not useful, in a sense, or then counterproductive. Okay, let me see what the next slide has. Okay, it's pretty much the same explanation. Let's go over it again. So interest rates and inflation, it's all related to demand. Okay, so if in scenario 1 where inflation is below target, the central bank lowers rates to stimulate borrowing. Okay, so low interest rates, you tend to get free money you tend to borrow money freely or cheaply to do whatever the hell you want to do. So higher borrowing means more economic activity. That doesn't mean it's good economic activity or organic economic activity. It means more spending, which, as I said, major economies right now are fueled, or they are living from this kind of consumerism. Okay, so the more you spend, the better it is for the economy. So higher borrowing means more economic activity, more spending, which usually leads to higher demand because you have free money available in your pocket and you don't know what to do with it. I'm going to go buy, instead of buying one t-shirt, I'm going to buy 5. Okay, instead of buying one car, I'm going to buy 3 because I have free access to capital and funds. Okay, so this creates higher demand, which thus leads to higher prices overall, which means higher inflation. Okay, you get the chain of thought. Okay, so as again, this lovely visual says it all. So lower rates leads to higher borrowing. Higher borrowing leads to an increase in economic activity. Highest increase to economic activity leads to high demand, which leads to high prices. So you are fixing, in a sense, the in this disinflationary problem where inflation falls below the 2% target. Okay, by giving money into consumers, into the economy to bring inflation back down, to bring demand up, and therefore inflation once again up. Because for some reason, we agreed that 2% inflation is the primary way of dealing with price pressures for a prolonged period of time. Okay, I'm not going to go into that. In the second scenario, where we have inflation being above the 2% target, central banks raise interest rates. This is how this is the chain reaction that is created. So if inflation is above target, central bank raises rates to curb high inflation. So we are at the opposite scenario where we have low or slow demand. Where we have high and hot demand, and we want to bring it down, because if demand remains super high, it's going to bring us towards the disinflationary. It's going to raise the probabilities of the economy going into the hyperinflationary point of view, or hyperinflationary phase, which is something you don't want. You don't want purchasing power of consumers be destroyed. Okay, so what central banks are doing to curb high inflation? Raise interest rates. Okay, so making the access to funds and capital and borrowing much more difficult in order to discourage people from borrowing, which is going to slow down economic activity. And if economic activity slows enough, that is going to lower demand. Okay, people are going to be much more skeptical on where they spend their money, and therefore that will bring down pressures. That's going to bring down prices of goods and services. In a sense, it's going to bring down inflation. Okay, that is the blunt tool that central banks are using in order to combat either high inflation or disinflation, low inflation. Okay, so how is that? Maybe we're going to do GDP as well, and then we're going to finish. I don't think we have enough time, guys. So let's finish off with interest rates. So interest rates and exchange rates. So raising interest rates usually causes a currency to strengthen. Might be counterintuitive, you may ask, but you will see how and see why. Reducing rates usually leads to a weakening of the currency. Okay, why raising rates may cause a currency to strengthen? It's counterproductive when you think that rising inflationary pressures is having a toll, or is bringing down the purchasing power of consumers. That is, in a sense, devaluing your currency. Why in this kind of case it's strengthening the currency? Doesn't make sense, does it? You'll see how. So you need to think of it from a different point of view. Okay, so when you see central banks raising interest rates, for example, from 1% up to 5%, okay, let's just say a random example, which pretty much major central banks have done so far, an actionable actual example that we have seen over the past year or so. So raising interest rates to 5% may not be, or it's not maybe, is certainly not good for the consumers of that nation, or those domestic consumers or those that want a loan from the bank in order to buy a business or create a business or buy a house is not good, but it's good from in the eyes of international investors, okay, or those investors that are abroad, that are foreign to that country. And you will see how. So if you have inflation, if you have interest rates of 1% and central banks over a period of 6 months brings it up to 5%, someone, and let's assume we are in the United States, someone from Europe, okay, where central banks keep their interest rates, the European Central Bank keeps its interest rate at 1%, whereas now the United States has 5%. What's the reason why someone from Europe holding euros, okay, in their deposit account, in their savings account, when you can move, let's just say that 100,000 euro into the United States, keep it in a bank, okay, you're going to convert the euro into the dollars. That's a small minuscule detail, but what's the reason why what's the reason behind a logical conclusion to keep the euros in Europe? In a sense, keep your money in Europe to get paid 1% of interest because you lend your money to the bank. Your account, your savings account, or in the bank, you are in a sense a lender to the bank, okay? You're not a borrower to a bank, you are a lender. You're giving your money to the bank, okay? So what's the reason why have my money 100,000 in Europe and get paid 1% of interest, or keeping my money in a euro denominated account where I can move my 100,000, I'm going to convert it into dollars and keep my money and keep my accounts in the United States, where banks in the United States pay 5% for keeping my money, okay? It doesn't make sense, okay? You are, in a sense, reallocating capital from your domestic economy into a foreign economy that pays a high interest of just keeping the money in the bank. You're not investing it or anything. You're just moving your money from one jurisdiction into a favorable jurisdiction where you have a big difference in interest rates. You get paid interest for keeping your money in the bank. Why keep my money in the bank and get paid 1% when I can just instantly, in this day and age, move it from, you're going to convert it, yes, from euros to dollars, okay, and keep it in the United States for 5%. Does it make sense? Of course you're going to do that. And that's what happens. That's why you get the strengthening of the United States dollar in this kind of case and the devaluation of euro. Because if you are in Europe and you have 100,000, and imagine, I don't know, a million other people doing the same thing, 100,000 moving 100,000 euros and converting it into dollars, you are in a sense selling your euros and you are buying dollars. That's why the dollar strengthens and the euro devalues, if you would like, or the relationship between the two currencies, which is what we have a pair in the FX market called the euro dollar, the euro against the dollar. That's why it devalues. That's why it falls when you have the United States raising interest rates to 5% and ECB, the Central Bank of Europe, keeping rates at 1%. Okay, 5 and 1. There is a net interest differential between the two nations. Okay, so there's a 4% difference between keeping my money in Europe whereas keeping it in the United States. It's favorable for me to move my money from Europe or to a low interest paying jurisdiction into the United States. Okay, does it make sense? That's why you have the strengthening of this currency in this kind of case, the dollar. And the example below, it has to do with Australia, pretty much the same scenario. I'm going to go over it just to read it through to consolidate these kind of things we just said, okay? And we're going to be finishing shortly. Guys, sorry for this. So raising rates usually causes a currency to strengthen, okay? And reducing rates usually leads to a weakening of the currency. So that's the complete opposite, and we're going to see the case here. You can think of this you can think of these reactions in the context of how much you get to save from your money at the bank. So in this kind of case, we have Australia. So if Australia suddenly raises interest rates, it becomes a more attractive place for international investors to save their money in. Okay, but to save your money in Australia, you have to exchange your local currency. Let's assume it's euro for Australian dollars. So in a sense, you sell euros and you buy Australian dollars. So this leads to more demand for Aussie, for the Australian dollar, whereas in this kind of case, the Aussie strengthens, and because you sell your euro to get Aussie, the value of the euro falls. Okay, so the flip side of the equation is, conversely, if Australia cuts rates, okay, to let's just say 2%, and Europe has a 4% interest right now, okay, the interest rate in from the ECB is 4%, whereas in the interest rates from RBA, the Reserve Bank of Australia, is 2%. Where is logical to keep your money? In Europe, okay? So you're gonna sell your Australian dollar to get euros, okay, and keep your money getting 4%, okay, instead of keeping it into Australia, which is going to give you 2%, okay. So it's a excuse me, it's an opportunity because it's a logical choice that pretty much international investors are doing each and every day or each and every phase of this kind of cycle, because it is a cycle, this kind of raising and falling of interest rates and this kind of shifts and changes of value between nations or currencies. Okay, all clear? If not, please guys let me know before I move on to the next chat. Give me a thumbs up. If you have questions, send them through. That's going to be a nice time. If not, I'm going to keep going for a little longer. Unfortunately, we have just now exceeded the threshold when it comes to time. Never mind. We're going to do another 5 to 10 minutes because we started a little bit late. So let's finish this slide. So why some central banks look at exchange rates. So how strong or currency, how strong or how weak currency is, it has implications for inflation, definitely. Okay, so as such, central banks tend to pay attention to the exchange rates. And more specifically, the reason why is because you have a weaker currency means that your exports, the stuff that you send to other nations, become much more competitive abroad because they are cheaper for others to purchase, for foreigners. But it also means that your imports, the stuff that you pay money to get in order to bring into your nation, become much more expensive because your currency is weaker in a sense, because you have higher prices due to high inflation. Thus, if you are a central bank, you're trying to raise inflation from, say, 1% to 2%, a target, something you need to do is to weaken your currency, okay, or conversely strengthen your currency in order to make your economy much more competitive in regards to its exporting capabilities. Okay, so on the other hand, a stronger currency brings the price of imports down, which may hold overall inflation in your economy down as well. Okay, so it's a double-edged sword that major central banks are yielding in order to fix these kind of imbalances in their overall economies, either favor strong imports or exports, depending on the situation. Okay, how many slides? Okay, so okay, let's do all of it. Okay, there are not many slides left. Let's do all of them. So another category is GDP, or growth rates, in a sense, measures the longevity or how robust or how strong an economy is. This kind of metric gives it to you. So gross domestic product is considered the broadest measure of a country's economy. Okay, so the higher the GDP, the better the economy is. That's an oversimplification, but pretty much that's how it works. So it represents the total market value of all goods and services produced in a country during that year. Okay, so everything that was created, manufactured, either it's going to be an item, It's going to be a microphone. It's going to be a camera. It's going to be, I don't know, a wooden table. It's going to be a factory, whatever that is, or it's going to be a service. For example, something like a streaming service or a music service or whatever that is. Everything that is produced domestically in that economy, okay, you get the value of all the things that were created during that year, okay. This is what we call GDP. Okay, so the higher the number of these kind of metric is, or the percentage is, the growth, okay, of production is, the better it is for that economy. Okay, makes sense, because you're producing more stuff, you're selling those stuff, you're getting money. If you have money, you're going to spend it in the economy, and you create more business opportunities and favorable market conditions, and blah, 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 and the economy grows. Okay, that's how pretty much what it is, GDP. That's why we look at GDP, and we're going to break it down into upcoming webinars more specifically, because it's a super, super important kind of metric that gives you a very nice assessment of how an economy is behaving. Okay, so it is the most important growth metric of a country's economy. There are many other different kind of economic new releases that are dealing with this kind of growth, but the traditional way of looking at things is the GDP. Okay, so in a nutshell, this is providing this metric, this GDP, this percentage is providing a health status update. So imagine going to the doctor and telling you, oh, you're fit, you're good to go, move. Okay, so it's a health status update for a country's economy. So at the end of the day, rising GDP means your economy is growing. If your economy is growing, that's going to attract international investors, bringing their money into the economy and setting up businesses and all that kind of stuff, which is going to amplify the growth of the economy. So they're going to set up businesses to your country, hire people and bring more money into it, and it's going to make the economy grow. Obviously, it's going to lead to a signaling of strong economy, which is going to contribute favorably to that country's currency. It's going to strengthen it because of higher demand, not only domestically, but internationally. But on the flip side, falling GDP rates, so deteriorating GDP rates, so not producing as many things as we were used to, is signaling negativity, is signaling that the economy is stagnating or is having problems. Okay, and nobody wants to go into a nation that is having problems, so international investors are staying away from the economy. Therefore, that country's currency is most likely going to weaken. Okay, or domestic producers and businesses are moving abroad in order to capitalize on the growth of other nations. So they are leaving their jurisdiction and they're going and they're going somewhere else. Okay, so if GDP is good news for everyone. Economy is going to grow, currency is going to grow. Falling GDP rates or negative GDP rates, not a good sign, means people are fleeing away from the economy, capital is not coming in, and then the currency most likely is going to deteriorate, is weaken. Those are oversimplifications, but pretty much they hold. Okay, this is the gist of it. Okay, this is not stuff written in stone. We're talking about an overall observation. Okay, last category is employment, one of also the most important one. So we have covered inflation, interest rates, GDP, or growth, and now we're going to do employment. Employment is super important because we're talking about the people that are, in a sense, working within that nation, that economy, to create those goods and services. So it's directly related to GDP. So the higher the percentage of people within that economy that is available and want to work, and they actually work, the more money they're going to get in their pockets, or at least they're going to get compensated. A high degree, a high percentage of population is going to get compensated for working. And if they have money in their pockets, most likely they're going to spend it. If they spend it, because we have this kind of this mechanical process of growing economies via consumption. If they have money, they're probably going to spend it. If you see spending, you're going to see consumption. This is going to lead to higher demand in a sense for goods and services. This is going to lead the economy or allow the economy to grow from there onwards because of higher demand, because we get money and because people are getting employed. Now, if you have high unemployment, people not willing to work or not being able to work, that is a problem because the country is not going to produce as much goods and services as it is capable of doing. Okay. So therefore, most likely you're going to see a fall in the GDP. A fall in the GDP is not good news because it can create a negative feedback loop where people are going to be fleeing away to find job in a different nation, or investors from abroad or companies, big corporations are not going to be bringing money into these economies because they are losers, quote unquote. Okay, you get what I mean. They're not performing as well. What's the point of setting up a $2 billion kind of company in a nation that is not growing? Doesn't make sense. Okay. So again, this creates a negative feedback loop, which is could potentially lead to a recession. Okay, big problem. So going back from the beginning, so employment, another lovely category. Fundamental analysts monitor key metrics when it comes to the employment in order to assess the tightness of the specific economy's labor market. How good workers are in a sense in that economy. Okay, how many people are employed? Are they doing their jobs? Are they getting compensated well for it? Etc. 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 Those are a few metrics that we look at. For example, the NFP, the non-farm payrolls, or the ADP, or the JOLTS, or pretty much employment change from the United Kingdom. Unemployment rate is another one, or how much people are getting paid for. We look at broader and more sophisticated, quote unquote sophisticated, economic metrics that tell us all how strong or how healthy the employment workforce of that economy, of that country is. And if it's good, most likely you're going to get a better GDP. If you get a better GDP, you're going to get a stronger currency. And if you're trading in the FX market, you can capitalize upon that. Okay, simple as that. Okay, so high employment within a country is a good sign that the economy is doing well. And in contrast, low employment, or in other words, high unemployment, usually signals weakness in the economy and is reflected in the country's currency valuation. Okay, so strong employment force leads to stronger currency appreciation. That's good news. High unemployment or low employment workforce, this is probably going to lead to a weaker kind of country's currency. Again, because nobody wants to invest in that country where people are unwilling to work. Okay, what's the reason of me setting a business in a country that you have a 30% unemployment rate, knowing that these guys don't want to work? That makes no sense. Why make the investment? Okay, so this is going to keep investors at bay. This is going to keep the country's currency devalued. Okay, so lastly, metrics such as unemployment rate, the initial jobless claims, and the non-farm payrolls are the most widely watched releases coming out from the United States, more specifically in a systematic fashion, and they are giving you snapshots of these kind of metrics, okay, these kind of categories to keep an eye on how strong an economy is, how strong a country's labor market is. Okay. This brings us to the end of today's session, guys. Do you have any sort of questions? Anything was unclear? If yes, send a question. More than happy to answer it. If you have found this beneficial or helpful or insightful, lovely thumbs up. It's going to be nice. So I don't think we have anything else to say. Was a great, okay, much appreciated, John. So yeah, hopefully all of you had a lovely Friday session. Hopefully this was not boring. If it was, please let me know. I'm gonna fix that. But I don't see any questions, so I'm gonna leave it here, guys. I'm gonna have to go away and do other stuff. Hope you all found this informative and hope you are all having a lovely Friday afternoon. For the time being, from me, adios, ciao, ciao. You being lovely. Ciao.